Greg Merlino is here, as I was telling you about just earlier, president and founder of Ameriway Financial Services. Greg, what do you think? Look at these markets, up more than 300 points. We're only an hour or so, a couple hours into trading on a Monday. You think this is going to last?
That's hard to say, Jenna. Clearly, the market's been oversold, and I think now is an excellent time to put some money to work. I certainly wouldn't go all in, but a dollar cost averaging strategy, I think would be very prudent.
What is that? What's a dollar cost?
Well, that's where you commit so much in dollars on, say, a monthly basis. When the market's down, you're picking up more shares at a lower price. When the markets are up, less shares, but over a long run, it is a defensive strategy, and it takes the emotion out of investing.
Certainly, we're down at 10, 12-year lows for many stocks and indices, groups as well. You would think people would perhaps be loading up to lower their cost average, but we've seen the exact opposite, and that's historically been the trend. The individual investor running for the hills when, in fact, they should be loading up and increasing. And part of this it could be because we've seen, dozens, maybe even scores of companies cutting down their contribution matches to 401ks. What has been your experience with your clients, over the past, prior to the start of this rally 2 weeks ago? What was the sentiment? Were people backing away when, in fact, they perhaps should have been adding to it?
Unfortunately, people don't view this like they should. If this was tuna fish we were talking about, everybody would load up their pantry.
Unless you didn't like tuna fish.
Right.
I mean,
people don't like to buy stocks on sale. That's the long and short of it. And in fact, given the degree with which we've come down in the markets, they've become paralyzed. They thought they were doing everything the right way, setting aside some savings, putting money into their 401k, and it hasn't worked out like they planned. So consequently, they're having questions with regard to, can they afford the retirement that they envision for them and their spouse? Can they afford to put their child or grandchild through college? Can they leave the amount of legacy that they were hoping for their grandchildren or perhaps great-grandchildren? These are the questions that, I don't care if you're a retiree on a fixed income or a neurosurgeon with a few $1 million in your profit-sharing plan, these are the things that are most important to you.
It's interesting. I asked our viewers, I said, hey, do you agree with Greg? Take some of the emotion out of investing. Is that a possibility? And Jimmy from Texas weighed in and said it's hard to not be emotional when you lose 45% in 6 months. People are feeling emotional about this market, and so your idea to take some money and put it to work, we've heard that before, but where specifically, what sectors do you see as, like, if you're going to dip your toe in, these are the sectors you want to be in right now?
Well, I think quality is key. We are overweight large cap growth right now. We are underweight financials, even though we've seen a nice move in that
particular area. Even with the bad
bank
plan out there, do you think you would change that as well as looking at the financials?
There's just too much uncertainty out there right now with regard to the specifics and how these banks are going to recover. We much prefer to stay in the large cap growth area, particularly tech. And the reason for that is their balance sheets are a lot stronger. They don't have some of the issues that other sectors like financials are having right now.
But even, Robert, you've been talking a lot about tech too recently, because some people feel like tech is going to break us kind of out of this recession. But doesn't a lot of tech have to do with the way consumers feel and consumer spending habits?
Not to mention corporates as well, corporations.
No question about it. And again, you're not going to go all in, but we're seeing just fabulous companies that are earning money, trading at levels that we haven't seen in years. So you're going to want to take advantage of that, and like I said, not load up in that area, but certainly put some capital to work.
So then how long, if you put capital to work, let's say you say, I'm going to put a certain amount to work in the market now moving forward for the next several months, how long do you keep your money in the market? I mean, how would you judge that? I mean, if you're going to put something to work, don't you want to know how much you're going to leave it there? Or do you put a price range on it that you decide to get off if the stock moves a certain percentage up or down? How do you work that?
Well, you can certainly put some stop limits orders in so that if we do see a correction, we can protect ourselves and get out at that moment. But we're talking, I'm not a trader.
Sure.
I don't believe in jumping in and out and trying to capture small movements in the market. My clients are looking for long-term investing.
So more for retirement preparation that way.
That's correct.
Okay.
And when talk about the psychology a little bit of talking to people. To me, it sounds like with the stock market over the past 6-9 months, it's sort of like the housing market. If you're standing here looking and you're going, wow, the price keeps coming down. When do I want to get in? Are you facing a little bit of that as well? I mean, with people just like, well, you know, my 401k keeps diminishing, everything keeps falling. I'm not going to put more money in there. I'm scared it's more, good money after bad, if you will.
And we're seeing a lot of that, particularly with younger employees. And I can't think of a worse move that they could make. What we're seeing is that people are stopping contributing to their 401k, or they're taking money out of equities and putting it into more conservative, stable value or money market accounts. That is absolutely the most devastating thing that they can do, especially if they're young. When these
What's young to you?
Well, I would say anybody under 40.
Don't do that.
No, don't do that at all, because these markets will recover. They've always recovered in the past. They will recover again from these levels. The problem with going into ultra-safe investments right now is you're getting paid nothing for them.
Nothing. You're practically paying, in some cases, short-term treasuries. You were paying the government at one point to hold your money.
Exactly. So when you get ready to retire, you're going to be looking at a nest egg that isn't near what it needs to be in order to meet your long-term retirement needs.
Okay, let's talk a little bit about the news of the day. Okay, we have the bad bank scenario that's finally been put out there for Wall Street to digest. The markets are rallying a little bit on that. You have more action as well from the Federal Reserve. And you have said that you are bullish on Bernanke. You agree with what he's done so far, and we've seen some huge moves from the Fed as far as what's going on with TALF, getting into the securities market, ensuring any type of investment. Do you believe that they're all tapped out, though? Is it over for the Fed as far as the headlines, or you think they have more room than they're leading on to have?
I think the Fed will do everything and anything in its power to give enough liquidity to this market and solve some of the confidence issues that are plaguing us right now.
And speaking of, sort of a parting thought, if you would, we have been asking people about buy and hold, and a lot of people are actually saying, yeah, over time, when Jonathan saying, you know what, I was buying when people were running for the hills in here. But they're also talking about reducing their holdings, particularly if one company gets too large. Say you owned a Citi or a B of A, in the run-up to the highs in 2007, that may have become an outsized position. I mean, just briefly, when someone starts moving above that 40, 50-year-old range, talk to us a little bit about how portfolio allocation comes into play, because obviously you want to get out of some of the riskier assets and more into fixed income and things along that line.
Absolutely right. And we're a big believer in diversification. So as opposed to, say, an individual stock position, we would prefer a mutual fund, maybe an ETF, that would diversify that investor over maybe 100 different companies instead of just betting on a Citigroup or a Wells Fargo or whatever. So that's diversification on one level. On another level, it's, well, how much do we have committed to stocks? And when you do get closer to retirement age, absolutely, you want to have less in that particular area. We're also, with our clients, it's not just stocks, bonds, or cash anymore. We're looking at alternative investments that aren't correlated to the stock market. And I think that that's helped from a diversification perspective as well.
What would be an example?
Things like managed futures, commodities. These are areas
and would you play some of those with an ETF, like the commodities, like a DBA or something? That's the ticker. I think it's the Deutsche Bank that holds a lot of the soft commodities in there.
Yes, absolutely. With regard to commodities, looking at ETFs, there are also some limited partnership issues that how managed futures are traded. So those would be the types of things that we would round out the portfolio with.
So you're having some people be a little skeptic, healthy skepticism. I mean, the market, let's see, the S&P is up right now about, well, 4.5%, so big move there. But if you look at it over the 52 weeks or so, the S&P is down more than 40%. So you have to have a little perspective on this. And what our viewers are asking us is, hey, Greg, how do you have confidence that the market is actually going to come back? We're in historic times. We keep hearing that this is like nothing we've ever seen before in our entire lives. But you still believe that no matter what, the market will still be there.
Look, we've just gone through a 10-year rolling period of negative returns in the S&P. From 1999 through the end of 2008, stocks returned negative 1.6% per year. That hasn't happened in 70 years. So if returns revert to their mean, then you got to believe that the next 10-year period is not only going to be decent for stocks, but it's actually going to be a lot better than average.
So is your money in the market?
Absolutely.
In stocks?
Yes.
Okay, hold that thought because we're going to